to Street Check, the podcast from Cabot Wealth Network, which has been offering investing information and education for more than 50 years. I am not Chris Preston, who is enjoying some much-deserved R&R. I'm Brad Simmerman, web editor, chief analyst of Cabot Wealth Daily. Joining me today is Tyler Laundon. He is chief analyst of Small Cap, Confidential, and Cabot Early Opportunities. Given that it's a shortened week and that I'm missing my co-host, we're going to break format a little bit and we're going to forego our Defend the Take segment. Instead, Tyler and I are going to discuss the news that's driving the market so far this month, what's happened this week, what we're looking ahead to, and then we're going to have a philosophical conversation about something that we've been talking about a little bit on this podcast, which is second order thinking, how to identify the trends that are coming, even if they're not obvious, or how to identify the co-beneficiaries of obvious trends that other people are missing. And before we get into that, though, I should note Tyler has an upcoming webinar. It's Tyler, what is the title of that webinar?
Brad, that's a great question, but I'm not sure on the specific title, but it is all about AI and kind of some of the investing trends there and what investors should be considering in the second half of the year when it comes to AI.
Yeah, that's great. And that's free to attend. You can go ahead and sign up, even if you can't make it, because you'll be able to get access to the recording in your email immediately. So I strongly encourage it. So in lieu of the big three, we're just going to talk what's happening in the markets. Obviously, a little bit of a sell-off yesterday. Given the strong run-up that we've seen in the month of June, it certainly feels like a normal rest period. We saw job numbers that were illustrative of the job market still being hot, but not quite red hot. And that was enough to put the fear of the Fed back into the market. Interest rates still at multi-year highs. What did you see in the news this week, Tyler, that stood out to you?
Yeah, I think, Brad, those two job reports are kind of interesting. It was the ADP one on Thursday that was stronger than expected. And then this morning we had that non-farm payrolls report, which has been coming in stronger than expected for like 14 months straight. It came in lighter than expected today. So that kind of continues this, back and forth between hard landing, soft landing kind of discussion. And, if you step back from the two reports, it's kind of like exactly where we were on Tuesday, right? No real change. It's just a matter of kind of seeing how these things shake out as we get back into the second half of the year. And of course, we have the Fed coming back up later in July. And so that's what I think the market is going to turn its attention to, as well as second quarter earnings coming up later next week when the financials kind of kick into gear.
I do think that second quarter earnings is going to be very instructive for the market. When the financials start reporting the ongoing impact of higher interest rates, deposit levels, especially at maybe smaller banks, regional banks. If you've got Pacific Bancorp or somebody that comes in that is missing expectations, do you think that there's still fear that we could get maybe a mini run on some of the regional banks?
Yeah, I mean, I guess there's always that's kind of one of those things that's really hard to tell, right? Some of these banks are so small that it's nearly impossible to try to predict that. I think that, if we look at what the data has been coming in, it seems like the banking system is relatively secure at the moment, and investors have a certain degree of comfort, I guess, that if another small bank goes under, it'll be controlled, not that big of a deal in the grand scheme of things. So I'm not particularly worried about, what may happen with a handful of small banks at the moment. I think it's kind of the big picture stuff, like what's the health of the consumer, what's spending like. All these the big banks passed their stress test recently, so dividends can go up. So I think there is a lot of kind of positive and stability news. And I think it would take something pretty significant to shake that confidence right now. So I'm not expecting like anything huge out of financial earnings next week.
Yeah, I think that's well put. I definitely see a case where as long as the big banks are showing stability and resiliency, and obviously we had the stress tests that you mentioned. There's probably an assumption among investors that the big banks are going to be able to absorb anybody that might be smaller and problematic. Still a case for probably being on your toes if you're investing in the smaller regional banks, but probably not going to be approaching any of those catastrophic scenarios that people were worried about in, February, March, and that time frame.
Yeah, right. I think if you're like playing with individual small and community banks, then that's you're going to want to be on your toes for sure. As you said, I think if you look at the there's a small ETF called the Invesco S&P Small Cap Financials, the PSCF, which is very thinly traded, but it kind of gives you an overall idea of how that area is trading. And I follow that, most weeks, and it's up decently from its lows. It's kind of stable, nothing spectacular there, but it's just kind of supporting the story that you and I are just talking about here, which is at the moment nothing really to see here. Could always develop, but
how has that performed in June? I believe you wrote this. Honestly, it might have been Rich, but Rich Howe, this microcap. But I think you wrote that the financials are a good metric to measure for the health of the broader market, and that if we saw increasing participation by financials in that June rally, that it would bode well. How's that performed in June, PSCO?
Yeah, so it's up 5% in the month of June. It was up a bit higher, I don't know, almost 10% within the first week and a half of June, and then pulled back a little bit. And it's kind of it's like one of those under the surface kind of metrics that isn't that widely followed. But if we're comparing it to like the XLF, the large cap financial ETF from Spider, then this one is obviously looking much more stable. I guess you could say higher highs and higher lows off of the March lows, but that might be a little bit of a stretch. There's no clear trend there, but yeah, I think the article that you're talking about, I did write that. Maybe Rich touched on it as well, but if we're just stepping back looking at like small cap asset class and trying to find out what could help those stocks come back, then looking at the financial component of that is pretty relevant. So that's why I watch it.
This one I'm going to spring on you. We didn't really talk about it in the lead up, but you reminded me of this. I've been seeing reporting that venture capital funding is taking major hits right now. The big buyers that used to fund these small startup companies, they're pulling back because we had 4 quarters in a row of like 100 unicorn companies funded by VC, which was like 5 times the average in any other year. It was all that sort of hype cycle, that 2021 hype money, easy money everywhere. Every asset class was inflating. Does that trickle through to some of the smaller names that you follow? Because you are in that sort of innovation space. If we see a pullback in venture funding, is that indicative of lower interest in publicly traded small caps or micro caps or innovative companies that you might otherwise follow?
Yeah, I mean, I think it's a good point. I think your data is right on. It's definitely been a slow IPO market after being like red hot. And for me, it's kind of interesting when we were in the pandemic how we kind of tend to think of IPOs as being smaller companies, but we had a huge number of like pretty significant size IPOs. Even like of course we had like Airbnb, but like Rivian was just looking at that. It's like a $25 billion market cap company. Obviously, it's much smaller than it was when it came public, but these are not small companies. A lot of which, the IPOs that came during the pandemic. I think now we're not seeing much performance in, say, like small cap biotech, which is, requires a lot of funding to get through, whatever trials they have or to get to the point of some significant trials. So I think that is being held back. If you look at the XBI, didn't you guys talk about this maybe last week or a couple of weeks ago?
Yeah, we touched on it a little bit, where it did look like the risk on assets were picking up a little bit of steam. You're seeing it in some of the crypto stuff, Coinbase running, Bitcoin running higher, XBI and the equal weight S&P all sort of outperforming the mega caps. So Chris and I had touched on that a little bit, and it's actually probably a good opportunity to transition to sort of our main point, which is how do you go about identifying trends that are either co-beneficiaries of an obvious trend? So your upcoming webinar on artificial intelligence, you'll touch on some of this, but everybody knows the AI trend. Everybody knows NVIDIA. Everybody knows Microsoft. Everybody knows Chat GPT. So where are our blind spots? And to preface that a little bit more, during the pandemic, everybody knew that some vaccine maker would be a major beneficiary, but the PPE manufacturers actually, that was one that a lot of investors overlooked. By that same token, we've been calling for revenge travel summers since 2021. Airlines exploding higher this month. Chris and I ran through some of those stats. What is it that made investors pay attention this time around, for instance, right? Like airlines have been saying that the surge in travel, the surge in demand is going to come down to the bottom line. They've been screaming it for 2 years or for a year, and they were telling us the truth. So how do you go about either identifying those secondary opportunities or knowing when it's signal versus noise?
Right. Yeah. I mean, I kind of think like the underlying challenge that you're getting at is the markets are just so complicated and so difficult to understand or, on a short-term basis or predict, that you're kind of looking for trends that have some staying power. And just trying to put the odds on your side with a trend, and then of course get into an individual company that can benefit, that has a number of things that are going for it. So I guess, if you wanted to talk like, stock market analyst talk, it's what I try to do is a mix of, top down, where you're looking at the big picture stuff, the trends, and then bottom up, where you're looking at individual companies, trying to figure out, do they have leverage to XYZ trend? And honestly, a lot of times I just am looking for a great company, and then you dig into it, you get to understand what's going to move the needle for it. And then you start going down that rabbit hole of whatever market they're in and what those trends are. And from there, you look for another opportunity and then another one that can play that trend. And you sometimes wind up with a basket of three or four stocks that are kind of all various plays on the same thing. And, like medical devices is one, which, we don't have to kind of swap over to that yet, but we do a decent amount of medtech investing in the small cap portfolio. Yeah, it's a great space. It's interesting. Margins tend to be pretty good, and we're in a good environment for that right now. I think back to your discussion on jets and the air travel. Did you guys get into, like, I haven't followed this that closely, but is a lot of the strength in the airlines from tourism, or is it also a recovery of business travel? Have you did you?
I haven't done a deep dive into where the resurgence is coming from. Anecdotally, everything I've seen has been recreational travel, and that, sort of narratively fits well with the fact that American consumers are shoring up the economy, right? It's the resilient consumer that's continuing to spend even in the face of higher interest rates, rising debt levels. We'll see what the student loan repayment resumption does. That could obviously be a big hit to the strength of consumers, but that's my understanding anecdotally. But I haven't done a big deep dive. But you mentioned medtech names. One consideration with that, those are very binary in a way that not a lot of stocks necessarily are. Because if you're in a promising medtech name and it's looking for device approval, that's a binary outcome. So
yeah, if you're looking for like an FDA approval for sure, then you're almost talking like a biotech stock, right? Which
sure.
If I'm looking at, I think biotech is much more binary, like pass, fail, win, lose type outcomes than med tech.
Yeah, because if you've got a hip joint and you're just saying that it's better than a different hip joint, it's business as usual. You're relying on your sales team. You're relying on the strength of the product. It's not quite that same binary. So I shouldn't lump those in together.
Yeah, I mean, I think your point though is well taken. It almost depends on what stage of development the company is at, right? If it doesn't have a commercial product and it is trying to put out a new, implant to help with vascular disease, some procedure, then that is very binary. It's going to either get approval for that or not. But some of them are a lot of the ones that I follow. It's at this point kind of like a volume game, and then also consistent evolution, introduction of new products, building a bigger portfolio so that they can have a whole host of tools available to the surgeons that are doing whatever types of procedures, whether it be like spine surgery or more general orthopedics or whatnot. But so I think as you get into the nitty gritty, you can lump things into different buckets of like risk, depending on exactly what market they're in.
So I have a question you might not have an answer for. I'm going to put it out as plainly as I can. So you've been writing for the better part, well, since the pandemic started, with some of the med tech names saying, hey, they're deferring performing procedures until after the pandemic sort of hospital capacity crush, after that resolves. And so we've been reading it, consumers have been reading it, investors have been seeing these deferred procedures. What's the blocker? What is it that causes the blind spot that doesn't allow us to look at insurers specifically? And so very specific hypothetical, and say, oh, wait, at some point, somebody's going to have to pay for these deferred procedures, right? Like United Healthcare took a 10% hit when they said, hey, we're finally seeing the impact of all these deferred procedures that these companies have been talking about for years. What's the blind spot? Just philosophically, I don't know that there's a specific answer to it, but
yeah, I think it's kind of like we as investors, we're trying to a certain degree, and it's dangerous. You're trying to sort of make predictions and position for things that might happen, but confirmation that it's happening or has happened is very different from an expectation that something may happen or when it may happen. You know what I mean? And I think that the expectations are very gradual, but then confirmation is like all of a sudden. It's a whole new bunch of information. So going back to your point on UNH, yeah, I mean that's a 420 billion market cap company. It's kind of a bellwether for that space. So a 10% hit on that is pretty significant. But again, it gets so granular that exactly how they're going to manage that, and are they going to work with the payers on reimbursement rates and all the complications that go along with that. But I think that for like somebody like me who's following small cap med tech, it wasn't really on my radar to think about what would happen with UNH if utilization goes through the roof. So I don't have a great answer for you. It might just be a matter of bandwidth for a lot of people and waiting for confirmation and then adjusting from there.
Yeah, as we were saying as we were discussing up top, that this is more philosophical conversation.
Yeah.
But I think that's I think the confirmation aspect of it, that sort of fills in the slot nicely in my mind. It makes sense narratively that like, all right, well, you have investors that are speculating on the health insurance companies, right? And then you've got so maybe they're buying puts because they are the ones that think, okay, well, this is what might happen. But then the more conservative investors that are waiting for confirmation of that breakdown or of that potential liability, they're the ones that are then that second order effect, the selling pressure on confirmation, or conversely, the buying pressure on confirmation once the airlines, started reporting actual impact to their revenue. So it's, I guess maybe part of the price of trying to be early is that speculative element.
Yeah, and if you're trying to play like a change in trend, then you really have to be on top of it, because things seem so obvious in hindsight, right? Like,
right.
We're like, oh, well, it's so obvious that utilization would be up, and so insurers would take a hit. And the same thing with travel. I mean, there are so many moving parts within, there's labor costs, there's materials costs, there's, or if we're talking about, sorry, I'm sort of mixing the discussion with health insurers and with airlines. But if you were to take any one of those industries, there's all different inputs, right?
Sure.
And how they're going to manage those. I think kind of just moving forward a little bit, talking sort of tangentially about travel, it's going to be really interesting to see what happens with Airbnb and bookings.com in the next 2 quarters, based on travel trends, people being out there. Are they pulling back? Are they being more conservative with their spending? Are they going back to hotels? What are all the trends that are going on in those spaces, and how are those? I'm interested in those 2 companies in particular, just because I've been following Airbnb for a while. But again, when you get into it, there's all these different levers that they're trying to adjust. So transitioning into AI a little bit, Bookings has put out a new AI feature to help travelers find places that they might want to book. On the other side of things, Airbnb is trying to go back and create a larger market for single room rentals and try to bring prices down on their platform. So I think that, probably after second quarter earnings and third quarter earnings, there's going to be some, well, that was obvious moments for each of those companies. But it's hard to say right now what those takeaways are going to be.
Yeah, I think that is right. I mean, you look at a company like Airbnb, where it's like, okay, well, on the one hand, you've got this rising travel trend. If a hotel's harder to get, put your available room up. But then the sort of counter trend to that is, I've been stuck in my house for 3 years. I don't want to go stay in somebody else's house, even if it's a different place that's also been lived in for the last 3 years. Personally, I have never used Airbnb. I've used VRBO a couple of times, but every successful trip has been for a property that is solely a rental property that nobody's living in. There's no family photos. The furniture is sort of like decent condition, the kind of thing you might find, at a Goodwill or whatever. But then I've also rented a house that was clearly a vacation home that saw a fair amount of use. There were weird German gnome dolls. There were family photos, and it's uncomfortable living in somebody else's space. So you're trying to, for me at least, as a writer and editor, like try and narrativize everything. So I'm sort of dealing with these dueling narratives in my mind of like, okay, well, yeah, travel's going to improve. People might be tired of staying at homes, and they may want the hotel experience more. You do a similar exercise with aircraft, right? Like, okay, well, flight travel is up. Well, that means aircraft maintenance is up. So maybe I should be buying more GE stock because they're going to be delivering more like rotors or more engine components or whatever, right? Like, you can sort of make that case. So let's close this up with a little bit of a brass tacks conversation. You identify a new trend. For the sake of this, it can be AI, it can be let's say electric vehicles, all right, or you can pitch whatever trend you want that you're most comfortable talking on it. There's a clear trend towards AI. There's a clear trend towards electric vehicles, what have you. what is the next step in identifying co-beneficiaries of that trend? How do you look at it from an investing standpoint and say, okay, I'm confident enough in this mega trend that I'm going to speculate through maybe a basket of stocks, 3 or 4 stocks or whatever. From a practical standpoint, how do you implement that and try and tack on a position in a trend, in a sector or subsector that's going to benefit from a trend?
Yeah, right. Well, I think let's talk AI, because that's what I'm going to do the webinar on next week, and what a lot of people are kind of interested in right now. I think that, you step back, AI is obviously a buzzword, and it has been for a while now, but you kind of step back and you think about what exactly is it, and what impact is it going to have on society, on these companies, and then ultimately what the market cares about is revenue and earnings, right? So for the publicly traded companies that we're trying to identify that can benefit from that, for me, it's kind of like you can put it into a number of different buckets. You have the micro, or you have the mega caps, obviously Microsoft, Nvidia, those companies that seem like clear beneficiaries. And obviously I'm a small cap guy, but that doesn't mean that you're only focused on small companies. I think like a Microsoft, you can use that as an example. Like, they have a gazillion other great things going for that company, and AI is one part of that. They can benefit from it, but if this buzz kind of wears off, it's not going to destroy the company. So they have leverage to it, but they also have they're not over leveraged to it. They're diversified. So there's that. I think Nvidia right now is a little bit different. They have a lot more leverage to AI and a lot more risk from it because of obviously the recent rapid move in the share price. If next quarter earnings just fall flat, or management isn't like, gung-ho on AI driven demand for their chips, and Nvidia stock could be in trouble. So there's a lot more risk in that name. I think for me, and when we look at like mid and small cap companies, really what I'm doing is looking at predominantly software companies that have leverage to AI, and the sort of Microsoft-esque ones are those that already have products that are doing well. They're showing revenue and earnings trends that are positive, and then AI could be an added boost to that. And
yeah, it's easy to envision how a company like a Microsoft integrates machine learning tech. Bing, right? Like, if I had written about it in machine learning in December, but like, if you're searching for a recipe online, I don't really care what website it comes from. I just want the recipe. I don't want to read 10,000 words about your summer in Vermont before I get to a recipe for French bread or whatever it is, right? Like,
those write-ups are always so long, aren't they?
It's nuts. I hate it. It's terrible. But I don't need that stuff. If you have a Bing chat bot that I can just type in, give me a recipe for French bread, and it gives me that recipe and excises all the extraneous content, that's a clear improvement. By that same token, where might I need a digital assistant? Oh, I don't know, if I'm working on a suite of office products, right? If I'm in Excel, a digital assistant might be very helpful because I might be trying to figure something out. And if it can potentially anticipate what I'm trying to figure out, right? Like, that's an easy fix. So you can see how it slots in really nicely. So I do think that that's a compelling case to identify companies both that are strong and positioned to benefit from the trend, and to identify companies that might be undiscovered. So how would you go about trying to identify maybe something that's a little bit undiscovered? With AI, it was tough. OpenAI was behind ChatGPT, private company. The majority of AI names that are sort of that are very early stage are private companies. And the biggest investor in OpenAI, even before ChatGPT took off, was Microsoft. They gave him $1 billion and threw another 10 at him after the end of last year. So how does one go about trying to discover the undiscovered? How do you find diamonds, right? Like that becomes a...
Well, I think for the average investor, they probably read, a lot of material from publishers like Cabot that are covering this and kind of leave, for if you're not behind the paywall, we write a bunch of free content and there's information in all of that. And then for our paying subscribers, they obviously get reports on specific companies and all that.
Right.
So I think that for like your average investor who just doesn't have a lot of time, it's pretty difficult to find those undiscovered companies if you haven't gotten a lead somewhere. Just because it's a time thing. But moving on from that, like for me, what I'll do is I'm following a whole bunch of companies anyway, and I'm relatively familiar with what products they have, and as you sort of start to understand where the leverage could be, you look at other companies that you're loosely familiar with. For instance, a couple companies that I'm familiar with are doing a ton of work with data crunching. They have products that are basically all based on data. And AI is a technology where they can control their labor costs by automating, 1 billion tasks or however many tasks every year. And if they can do that repeatedly and do that really well, then that's not a customer facing AI interaction like you looking for a recipe,
right?
But it's an automation capability that is built into their platform so that when their customers are asking for that software to do something for them, it spits back what they're looking for without that customer having to have a whole bunch of labor providing those results, which saves them from offshoring that labor to, a lower cost place. So that's, I think that AI dovetails nicely with data rich software companies. That's one area. There's also a lot of leverage for let's see, I'm trying to think of exactly for product development, for software development, as learning models get better. So say you have a consumer facing application, you're a software company with a consumer facing application, or say 5 consumer facing applications. Every time a consumer interacts with your software, you gather more data about that person. And so having AI capabilities internally that work smoothly to crunch that data and, have the right algorithms and have the right infrastructure, that gets smarter and smarter, and that can help inform the creation of new features. Doing small tests on every little feature, like do consumers in the United States prefer, a blue button over a green button? What are the response rates for that over the course of 3 months or 3 weeks, whatever? And so those are like really, really specific, granular examples that nobody's really going to talk about those because, your eyes kind of glaze over and they're pretty boring. But if you're looking for opportunities, those are the kinds of companies that are actually doing something very, very specific with the technology right now. And when you do that over the course of 3 or 4 months, couple of quarters across a portfolio of products, that can really make a significant difference, whether it's generating new revenue or cost savings within. And so I think kind of bringing it back around to like right now, so we have second quarter earnings season starting up next week, like we talked about with the financials. I think that it's going to be, for a lot of companies, like a make or break quarter for their AI enthusiasm. Because are they going to deliver something to the market that is saying, we're actually doing something with this technology, right? Both analysts and self-directed investors are going to be like, well, either you are or you're not. And how much hype are you trying to generate versus how much legitimacy do you have for actually doing something with this technology? So kind of like swayed back and forth there, but I think you know what I'm.
Yeah, so last week Chris and I made predictions for the rest of the year. Just fun throwaway predictions. Nobody has a crystal ball, so we don't know. But one of my predictions was that this quarter would put to bed any AI hype. Any company that benefited specifically for the hype aspect of AI, that said they're integrating AI that don't actually have a practical reason to do it or a beneficial outcome from doing it. I think this quarter is going to be rough for them, or maybe they just quietly step back from that ledge. But what I have taken away from this conversation, and I'm going to try and frame it in a way that's practical. If you have identified, or if you're looking at an obvious trend or a market driving trend like AI, like EVs, like travel right now, the best approach is take a second, think about the obvious beneficiaries of that trend. If this is true, what else is true? It's called second order thinking. You apply a little second order thinking and you come up with possible outcomes, possible other beneficiaries, and then you build a robust watch list. And you follow those companies and you look to see whether they are actually deriving benefits from the primary trend. Would that be a reasonable approach to take to try and find some of the undiscovered gems? Maybe not get in before anybody knows about them, but know about them as soon as everybody knows about them? Like that, is that a reasonable approach to trying to trade a non-obvious trend?
Yeah, definitely. And I think following those watch lists and not sort of understanding that things are incremental, just like learning anything, right? You're not gonna learn everything overnight. But so taking that watch list, following it daily, weekly, quarterly, whatever. And then as things evolve and your understanding gets better, you can branch off and go deeper into more specific trends within those different companies. And yeah, I think that makes a lot of sense, Brad.
Well, thank you. Glad we hammered that one out. So that is going to do it for us today. Remember, next week on the 13th, Tyler's webinar is 3 little-known stocks to take advantage of the AI boom. If you're interested in the co-beneficiaries of the AI trend, if you're interested in more of his methodology, I highly encourage you to sign up. It's free to attend, and if you don't attend, you get an email link to the recording as soon as it's available. So it'll help you gain some additional insight into AI and to get some of the names that we've been sort of talking around, I believe. And so that'll be coming up on the 13th. Sign up. One other request for anybody that's listening or watching, email us at streetcheck@cabotwealth.com if you have any feedback. We are very curious as to what segments you like, what segments you could do without. Let us know. And everybody have a good weekend. Tyler, thanks for joining me.
Thanks, Brad. Have a nice weekend.